Welcome to the Techno Fundamental Report for June 26th. Major casualties or major situations have occurred throughout all time. World War II, thank goodness for Winston Churchill. He really created so much optimism for the British that they were able to get through the war. And then you had the Philippines with MacArthur. You had the Cuban Missile Crisis. You had Six-Day War. Desert Storm. 9/11, Iraq, Brexit, and then COVID-19. These were all difficult periods, but here's what's interesting. The S&P 500 after major geopolitical events, so we start with Korean War, Cuban Missile Crisis, and so forth. And this was the return 12 months since the attack, the invasion, or the major event. So you can see with the Korean War, the Cuban Missile Crisis, so forth and so on. Now, 9/11 was a different story, major catastrophe. COVID was a different story because the market dropped so much that it had to come back so much. So it kind of skews the numbers. But you come out with a 14.2% average return 12 months later after the conflict. Art Cashin used to say, sell the buildup, buy the invasion, is an investment adage that suggests a market strategy in times of potential military conflict. So the best thing to do is stay calm and realize that there's probably going to be a recovery. Now, I want to introduce a new indicator that I've been using for quite a while, but I still think it's something we've never talked about. It's called average true range. And Mike Webster over at IBD is a big proponent of average true range. This is all about risk management. William O'Neill says, my philosophy is that all stocks are bad, and I would say it's even 90% bad. There are no good stocks unless they go up in price. If they go down instead, you have to cut your losses fast. Letting losses run is the most serious mistake made by most investors. So this is all about risk management, having a process to deal with risk. Buffett says rule number 1 is never lose money. Rule number 2 is don't forget rule number 1. Good thinking. Now, here is a graph of CoreWeave. Now, this is a new IPO that came out recently, and I'm just using it as an example. The point making here is with average true range, we use a parameter of 21 days. So what that means is that you take the last 21 days and you average the ups and downs, like you can see here, very volatile, very, very volatile. So average true range is a number, and it's something you should be aware of. The average true range on CoreWeave is 14.219, which means that the average up and down move for the last 21 days has been roughly 14%. Now, that's a little difficult for me. That would be difficult for me because it's just too volatile. So what we're dealing with here is volatility, and average true range is just a way to understand when you go into a stock, how volatile is this thing? So if let's say you set a stop loss of 10%. Well, if you've got an average true range of 14%, the chances are pretty high you're going to get stopped out. So what we say is that if you're a new investor, not really experienced, probably use a 3% average true range. But, if you're an experienced investor such as myself, and I use a 7% average true range. So it's a great tool. You can get it with most chart services, and it just measures volatility, and that's the big risk. Now let's take a look at the market. As you can see here, NASDAQ making good ground here. We're starting to break out above this base. We're starting to make some new highs now. So that's what we've been lacking, and we'll get into that in a minute. But anyway, S&P 500, basically same thing. We've got the 21-day and a nice uptrend. You got the 50-day and a nice uptrend. 200, everything's above the 200-day. In fact, the primary trend continues to be up, and it's strengthening. So you can see here, high, low, higher high, higher low. Uptrend, that's what you want. Now remember, in an uptrend, you have a 75% chance of being successful in your stock investing. In a downtrend, you have a 75% chance of not being successful. So you got to make hay while the sun shines. So you can see here, same thing with the NASDAQ. We're in a nice uptrend here. This is a bull market. Now, new highs. This indicator is new highs minus new lows on the NASDAQ. You can see here we have broken out of a range, and we have broken out in a meaningful way. So one of the big things that I've been waiting for to get super aggressive is to see an improvement in the new highs and an improvement in new leadership. We're seeing it. NASDAQ divided by consumer staples. This is the aggression index calculated on a weekly basis. Hitting a relatively new high here, looking very positive. We're about to get a golden cross here between these moving averages. Now, if we look at it on a daily basis, we've already gotten the golden cross here, and we're making a relative new high. So that means to be aggressive. Now, if you're doing something like this here, which was back in the bear market of 22, you want to be defensive, which means you want to be in cash primarily. Now, here we are with interest rates. Interest rates are looking very constructive. I think the Fed's going to cut. Now, that's what this indicator is all about, because when you go below zero on the power index, it's saying that for the last 125 days, the yield on the 5-year Treasury note has dropped by 12%, which is the market's way of saying the Fed's going to cut interest rates. So we're looking good here. Interest rates are down below 4%. That looks very positive. Also very positive, the volatility index, the VIX. Just like the average true range, you want to keep an eye on volatility, because that's where the big risk is. Well, you can see here we're stabilizing down here below 21, actually about to hit a new low, which would be very positive. Price of oil coming way down here after this skirmish in Iran, and you can see that the trend really didn't get going. It's been in a long-term downtrend, and I think it's going to resume. So I would kind of stay clear of the oil industry. New lows on the New York Stock Exchange, very well under control. The sellers have dried up. We got a bunch of sellers in here, and then finally they started to dry up, and that's a very positive sign. Now, ARK Innovation is a growth ETF. This is a very growthy mutual fund, basically, or exchange-traded fund. And you can see here has developed a very nice uptrend. And also notice here the average true range on this is around 2.1, 2.2, which to me would be pretty good, because if you have let's say a 10% stop loss, you've got daily volatility that appears to be about 2%, 3%. You can probably handle this thing. So it's looking positive on top of that. Now, another example would be, here's the semiconductors, which are more volatile. 6.49, 6.5 on the average true range. However, we're breaking out to new highs. This is a very risk-on group of stocks. It's just basically saying that technology is where you got to be, because the projected growth rate in earnings for the next year, next 12 months, the projected growth rate on technology is about twice that of the S&P 500. So you have to pay attention to it. And we do own a lot of technology stocks, and we're doing quite well with them. So if you have any questions, let me know. Market's looking good. Finally turned the corner. Let me know if I can help you.